Hi, this is Steve Bray with this week's Cool Tools News Spool. By now you're probably aware of the potential damage the Dodd-Frank law and the qualified mortgage rule will have on the housing market. Those of us in the lending community are doing everything we can to mitigate the effects on your home buyers. However, there are some effects we cannot mitigate. One of those is the slowing of the closing process. The qualified mortgage or QM rule requires lenders to verify a borrower's ability to repay a mortgage or face significant legal risks. Lenders must consider 8 factors, including the borrower's current employment status, debt obligations, and debt-to-income ratio. The problem is best efforts don't count, and lenders cannot correct errors after closing. As a result, lenders have added a number of quality control checks, many of which happen just before closing. They include checking shortly before and sometimes after closing that the borrower is still employed, checking that the borrower hasn't applied for any new credit or taken on any new debt, recalculating the borrower's income to verify the debt-to-income ratio is under the allowed limit, verifying the closing costs don't exceed QM limits, and verifying the final loan terms don't violate QM guidelines. These are in addition to other quality control checks designed to verify the transaction can be completed legally. Based on recent transactions, I estimate the additional quality control procedures are adding 2 to 4 hours to the closing process. So far, lenders and their service providers seem to be absorbing the cost associated with the extra efforts. But don't be surprised if your homebuyers get stuck with higher closing costs later this year. For more information on the qualified mortgage rule, check out my earlier videos. You can find them on our Cool Tools for Realtors Facebook page or on our Texas Lone Star Lending website.